This PowerPoint describes the accounting for the payment of debt service, meaning the payment of principal and interest on bonded debt. As you know, the payment of debt service is accounted for generally in a debt service fund. For our example, on January 1st, 2012, Bond City issues $100 million of 6% general obligation bonds. Principal of the bonds will be paid in equal annual installments of $5 million beginning on December 31st, 2012. Interest will be paid semi-annually beginning June 30th, 2012. The city establishes a debt service fund to account for the payment of principal and interest on these bonds. Principal and interest will be paid from a special property tax levy, earnings from investments in the debt service fund, and to the extent these two sources are not sufficient, transfers from the general fund. The city estimates that for 2012, it will receive $8 million from the special tax and $60,000 in investment earnings. Under the bond indenture, the city covenants with the bondholders that it will retain $2 million of the bond proceeds in the debt service fund as a reserve for the protection of bondholders. This is a fairly typical covenant for a municipal bond. It's intended to make the bonds more attractive to investors and therefore obtain a lower interest cost for the bonds. So first, the city will record its budget for the debt service fund for the year 2012. Again, as I said before, the city estimates that investment earnings on the debt service fund will be $60,000, estimates that property tax revenues from the special property tax will be $8 million, appropriations for interest will be $6 million, which is 6% of the $100 million principal. They're 6% bonds. Paid semi-annually, June 30th and December 31st. Appropriations for principal will be $5 million. As you recall, principal is paid annually in $5 million installments beginning on December 31st. Remember also that to the extent that investment earnings and property taxes are not sufficient to pay expenditures from the fund, the balance will be made up of a transfer from the general fund. So in order to fund the $11 million in debt service, in addition to the investment earnings and the property tax revenues, the city needs to transfer $2,940,000 from the general fund. So we show that as an estimating financing source. Also, finally, the city has promised bondholders that it will retain $2 million of the bond proceeds in its debt service fund as a reserve for the protection of bondholders. So we will show in the budget the estimated financing source, the transfer of $2 million of the proceeds from the capital projects fund, and the increase in fund balance, in this case budgetary fund balance, by $2 million to indicate that we are not spending that money, we were just holding it in the debt service fund. Of course, there are no budget entries in the governmental activities because, again, we don't use budget accounts in the governmental activities. So next, the city actually sells the bonds, the $100 million in bonds, at a premium of $200,000. There are no issuance costs. The issuance of the bonds is recorded in a capital projects fund because the proceeds will be used for capital project. But then we have to transfer the premium of $200,000 and the $2 million to be held in the reserve from the capital projects fund to the debt service fund. So in the capital projects fund, we record the receipt of proceeds and premium on the bonds, $100,200,000 in cash, with another financing source bond proceeds of $100 million and other financing source bond premium of $200,000. We also record in the capital projects fund the transfer out of the $2,200,000 to the debt service fund. In the debt service fund, we record the transfer in of the $2,200,000 from the capital projects fund. And in the governmental activities, we record the issuance of the bonds. And again, remember, because the governmental activities are on an accrual basis. The issuance of the bonds results in the creation of the two long-term liability accounts, long-term bonds payable and unamortized bond premium, in contrast to the way they were recorded in the Capital Projects Fund, which on a modified accrual basis, we record the issuance of the bond as two other financing sources, bond premium and bond proceeds. The transfer from the Capital Projects Fund to the Debt Service Fund does not affect the governmental activities because both of those funds are internal to the governmental activities. Next, the city purchases $1 million face value amount of U.S. Treasury bonds as an investment for some of the money in the debt service funds. The bonds pay an interest rate of 6% annually, or 3% each semi-annual period, and mature in 7 years. They're purchased at a discount at a cash cost of $894,369, giving the city an effective yield of 8%. So we record in both the debt service fund and the governmental activities the purchase of these bonds as an investment with $894,369 in cash. During the year, the city receives two semi-annual interest payments on the Treasury bonds of $30,000, and by the end of the year, the fair value on the bond has increased by $11,781. So we record in the debt service fund the receipt of the cash of $60,000. We also increase the book value of our investment by $11,781, and those two amounts combined are recognized as revenues or for investment earnings from investment earnings of $71,781. The entries are the same in the governmental activities. Again, remember, in the modified accrual debt service fund, investments are recorded at fair value, the same as they are in the accrual basis governmental activities. Okay. During the year, the city collects $7.5 million of the $8 million in special property tax. Of the balance, it expects to collect $400,000 within 60 days of year end and $100,000 in the following year, but more than 60 days after the end of the year. So if you recall back to the rules for accounting for property taxes that we covered in Class 3, under the modified accrual rules, we can only recognize property tax revenues that are measurable and available. And available is defined to be received in the fiscal year or within 60 days of the end of the fiscal year. So in the debt service fund, we record the receipt of the cash. We recognize the receivable for the remaining $500,000, but we recognize only $7.9 million of the total amount of the property tax, and we defer the $100,000 that is expected to be received more than 60 days after the end of the fiscal year. In the governmental activities, we also record the levy and receipt of the property taxes, but we don't defer the $100,000 in revenue because, as you recall, the measurable and available standard does not apply in the accrual basis governmental activities. Next, the city transfers the $2,940,000 that was budgeted from the general fund to the debt service fund. So we record in the general fund the transfer to the debt service fund, and in the debt service fund we record the transfer from the general fund. Again, there are no entries in the governmental activities because both the general fund and the debt service fund are part of the governmental activities, so this transfer is internal to the governmental activities. Next, the city makes its first interest payment on the bond on June 30th. At the same time, it also amortizes $5,000 of the bond premium. So in the debt service fund, we record as an expenditure the payment of interest, the $3 million, which is the face amount of the bonds, $100,000, times 6% interest, times 1/2, because this is a semi-annual interest payment. And we credit the payment of the cash of $3 million. Note that we don't record anything in the debt service fund having to do with bond premium because we don't recognize bond premium as a liability in the governmental funds. In the governmental activities, we recognize the payment of cash of $3 million with a credit. We recognize the amortization of the bond premium, meaning a reduction in the liability account unamortized bond premium of $5,000 with a debit. And we record interest expense of $2,995,000 because the amortization of bond premium reduces interest expenses. So the amount of interest expense is less than the amount of cash paid. Next, on December 31st, the city makes its second interest payment on the bonds and its first principal payment, and it amortizes another $5,000 of bond premium. So in this case, our entries are the same as they were on June 30th, except that now we've also added the payment of principal. In the debt service fund, the payment of principal of $5 million is an expenditure. Again, because under modified accrual accounting, we are only looking at the flow of current financial resources, and there's no long-term liability for the bonds recognized in the governmental funds. So the payment of principal is always an expenditure. In the governmental activities, on the other hand, we do recognize the $5 million payment of principal not as an expense or an expenditure, but as a reduction of the long-term liability account, long-term bonds payable. At the end of the year, the city closes out its income and budget accounts for the debt service fund. Again, in this case, we're assuming that because this was a budget for the year, it will be closed out at year end. Note that the income statements, the balancing entry is fund balance is restricted because, again, all the funds in the debt service fund are restricted for the payment of debt service. And the closing out of the budget accounts is basically the exact opposite of what we recorded at the beginning of the year. So our income statement for the debt service fund would be as shown. We see that we had zero fund balance in the debt service fund at the beginning of the year, but it has now grown to $2,111,781, which includes the $2 million that we've promised to hold in the debt service fund for protection of bondholders. And our balance sheet for the debt service fund would be as shown. And here you see the fund balance at the end of the year of $2,111,781, all of which is restricted because it's restricted to debt service.